Let's come back from the lunch break, please.
Still missing a bunch of parties.
Is your next witness on the platform?
Yes, Madam Hearing Officer, our next witness is Doug Emmerich. He's our surety expert in financial assurance.
All righty. Mr. Emmerich, can you unmute yourself? Sheila, have you given him permission to unmute?
Yes, I have.
Okay. Mr. Emmerich, I understand pressing Control-Shift-M might be the secret.
Can you hear me?
Yes, now I can. Thank you. Would you spell your first and last name, please?
My name is Douglas R. Emmerich. First name Douglas, Douglas. Last name Emmerich, Emerick.
Do you swear or affirm to tell the truth?
I do.
Thank you very much. Go ahead, Mr. Suazo.
Mr. Emmerich, good afternoon. How are you today?
I'm doing well.
Excellent. Will you please state your name and occupation for the record?
For the record, my name again is Douglas R. Emmerich, and I am the Director of Operations of the Insurance Expert Network.
Can you tell us about your educational background?
Yes, I earned my bachelor's degree from Gannon University in business administration, and then I attended a training school for the insurance company I worked for and got my certificate for insurance and fidelity and surety bonding shortly thereafter.
And how long have you worked in the surety and bonding industry?
I worked for the insurance company and companies that sold things to the insurance industry, and finally with the Insurance Expert Network, all told over 40 years of experience in the surety and insurance industries.
Do you also operate your own consulting firm?
Well, I wouldn't call it an active operation, but I do locally offer computer help for people who need it.
Okay, and can you describe your experience underwriting oil and gas plugging bonds?
When I was with the insurance company, I was at one point in the Dallas office of that company, and I was an underwriter of oil and gas plugging bonds at that point. And I wrote Texas, Louisiana, and Oklahoma plugging bonds. Unfortunately, even though New Mexico was a neighboring state, I never looked at New Mexico at the time I was there.
Okay. Are you familiar with the surety markets across multiple states then, specifically as these sureties apply to energy companies?
As far as surety underwriting and approach to surety matters, yes, I am.
And have you previously been qualified as an expert witness in other proceedings on financial assurance?
In several court cases around this country, including Massachusetts, Florida, California, I think, but all this information is in my CV, and Louisiana, and every time I have been involved in such a matter, the court has confirmed that I am able to be considered an expert in surety and insurance matters.
Very good. Turning to your role in this proceeding, for whom are you testifying today?
I am testifying for NMGOA, and I will say, even if I were hired by the applicants, I would be saying the very same thing. But the process for securing a surety bond, the associated costs for bonding, and explaining the challenges that companies will experience in securing sureties at a reasonable cost. And of course, that reasonable cost phrase is a very subjective term.
And Namoga appreciates you being here on their behalf today. Before we turn to the substance, let's start with your slide 3. Could you please summarize the purpose of your testimony and the main concerns that guide your analysis?
The applicant's proposed changes are not as straightforward as indicated and may contain several unintended consequences because the surety industry is a very different animal, if you will. Applicants' proposals also display a clear lack of understanding of surety market functions and dynamics. And of course, surety operations are primarily within insurance companies. Further, applicants' proposals are not based on robust industry input from the sureties and fail to consider more viable alternatives.
Did you listen to the testimony of Dan Arthur earlier today?
Yes, I did.
Did you hear him discuss, I guess, kind of a rough comparison between an insurance policy and a surety?
Yes, I did.
Okay. Do you have any thoughts about that for clarification purposes?
Yes. I think that the hearing officers may get the wrong idea. Insurance and surety, even though they are divisions most of the time of the same company, are very, very different. Insurance, as was discussed, may contain liability or property coverages and a myriad of other matters. And it is written to people who want that insurance, and a premium is charged. And those insurance companies expect to lose on some of those policies. Frequent losses overall on the whole portfolio of insurance for companies could be anywhere between 30, 60, and even 90% sometimes for insurance policies. Whereas surety is always written to a 0 loss ratio, which means at no time do sureties expect to have a loss, and they change underwriting to maintain that 0 loss ratio. Now, in reality, losses do occur. I'm not saying we're perfect as underwriters, because we're not, but if losses go over 30% for the year, wholesale changes to that company's surety processes will begin. Further, they constantly look at current events, changes of attitudes, and even legislation, court cases, etc., to inform surety underwriting practices. It depends on the type of surety that is being written and what the exposures are as far as the surety sees them.
All right, and we'll get into greater detail later on in your testimony, but let's move on to slide 4 of your demonstrative exhibits. Can you please state your general understanding of the proposed amendments?
Yes, I'm not here to explain particular rules. I'm here basically to explain the reaction that sureties will have to what the rules are. And I particularly focused on the single well financial assurance of 150K for mini well types. And it seems to me that they will generate a dramatic increase in surety requirements. Further, the increase will make sureties unavailable to many operators simply because they have previously underwritten that operator for under the current regime, and this change, which for some operators, not all, will increase the number of bonds necessary and the total liability at risk. And that change in bond amounts are paramount to consider, because that change will cause sureties to take many actions, and we can talk about that later.
Sure. And based upon your review of the proposals from the applicants, is it clear to you how many operators and wells that these changes would apply to?
Well, I didn't focus on that particular thing, but any well that is defined as marginal will require that. And those operators that have multiple wells, and particularly those operations that have more than 50% of the wells that they own classified as marginal, every single well of that operator will need that $150,000 single well bond. And for some operators with many wells, that will astronomically increase the amount of liability that the surety has to consider for writing those bonds.
Very good. And I'd like for you to help the commission understand how the surety markets actually function. Can you explain to the commission what a surety bond is and how it can you assess how the surety industry differs in its approach to risk when issuing bonds?
Well, given that there is an attempt by sureties to maintain a zero loss ratio, you can imagine for these types of financial assurances, the surety will look at the financial, but not only the financial aspects of that operator, but also the past history of that operator. So they will have information coming into them of operators that have no violations. They will have information coming into them of operators that have some violations. It just depends on who they're looking at the time. And the important thing is that the surety wants to ensure that that bond that they're taking on will not cause them a loss. And remember, very different from an insurance policy. A surety bond is tantamount to a loan that a bank would make. It's not exactly that, and I don't intend to anybody to pin me with a suggestion that they are the same. They're not the same, but they're closer to being a loan than they are an insurance policy. An insurance policy is a promise to pay for the terms of the policy that the insured bought. Remember, an insurance policy is a contract of adhesion, and that means the insurance company wrote the policy. If you agree to buy it, then you have to agree with the language that is in that policy.
Okay, and you touched on, sorry, I didn't mean
Go
to cut
ahead.
you off. So you touched on the zero loss principle earlier in your testimony. So we're going to move on to slide 6. But before we do that, does this practice by the surety industry tie up additional operator capital and reduce liquidity?
If it's just a bond, the bond in and of itself doesn't tie up capital. But some bonds that are particularly hazardous, sureties will require collateral. And that collateral is what will tie up the working capital of the operator. So that can happen.
Okay. Now, moving on to your slide 6, how do surety companies generally approach risk in underwriting commercial plugging bonds?
Again, the more hazardous the bond is, the more information the attorney gathers to evaluate. And the surety will evaluate, again, the financial qualifications of the operator, and will also look at the people running the operation. They will pull in resumes. They will look for additional information from generally publicly available places. They will even pay for additional information at times in their analysis of the credit and the business qualifications and performance of operators before they make a yes decision on the bonds. And for the financial information, they will want each operator to have a certain amount of working capital on a continuous basis. And that is very important for a surety to know, understand, and keep on top of over time for as long as they write that bond.
And how does the amount of collateral as a percentage pertain to the bond amount that's issued?
That is dependent on each surety company, but generally speaking, surety asks for collateral somewhere around 50 to 100% of the bond amount.
Okay. And moving on to your slide 7, when financial assurance requirements are increased as they are proposed to in this proceeding, how does that affect a surety's behavior?
Again, sureties will want to make sure that they will not have a loss on that bond. And the only way they have to do that is research, as I have indicated, the operator, and then also charge collateral to back up the bond. And there is an indemnity agreement with each bond issued that guarantees to the surety, as much as can be said, to pay the surety back if the bond is forfeited.
Okay. And moving to slide 8, can you explain to the commission how applicants' proposals would affect operators with varying numbers of wells?
That is one of the most disturbing parts of this. there are provisions or a provision that says if you have more than 15% of your wells that are designated marginal, then not only are those marginal wells required, but every well of that operator is required to provide a single well financial assurance of 150,000. Now, it doesn't make a whole lot of sense to me to require the other wells that operator has that aren't marginal to provide that 150 single well bond. They're not marginal, and they don't show any sign of becoming marginal, some of them anyways, and it doesn't make a whole lot of sense to do that unless you're characterizing that particular operator as someone that will send all their wells to marginal status. And that just doesn't make a whole lot of sense to me. And quite frankly, when you're increasing bond amounts from 250 to possibly someone with 10 wells to 1.5 million, or with 50 wells to a total bond amount of 7.5 million, many operators simply will not get a surety interested in writing those bonds. If they have been approved by a surety to provide a blanket bond, they have been approved by the surety to 250,000, most likely.
Okay.
It could be one of the former blanket bonds of 50,000, whatever that amount is. What I'm trying to say is that the surety approved that operator for whatever that bond amount is. When you dramatically increase the bond amounts that operator has to provide in total, that's when a surety will start refusing to write additional bonds for that operator, or they'll approved so many to get up to what they think the operator can qualify for.
Very good. And so tying that information back to the zero loss model that you discussed earlier, in this situation or under these proposals, why does the zero loss model matter? As you kind of lay out on slide 9.
And that is the real conundrum of surety underwriting, because the sureties are always trying to avoid that payout. In other words, to avoid having any losses. That's what fires the surety's decision for collateral and limiting the total amount of bonds for that particular operator. Now, sureties also look at the regulatory risk for providing a bond to an operator. If they think badly, for whatever reason, that the regulator is a little onerous to its operators, that means the surety will require higher collateral. They might go from 50 to 100%, or they go from not asking for collateral at all to asking for collateral. And non-cancelable New Mexico bonds magnify that exposure because they're not cancelable. One option except for very few bonds, the surety is able to get off of them by canceling them or non-renewing them.
But
One
in New
story I
Mexico,
can
that's
tell,
not an option, correct?
it is for New Mexico, Colorado, and I'm not sure where else. Those are non-cancelable bonds. Surety has no option, and I can tell you that when I was underwriting him in Texas, there was an oil and gas economy collapse at the time. And what we did in Texas and for all the states we were writing for at that point is when the bonds came up for renewal, we non-renewed. It's not exactly a cancellation, but a non-renewal is a tough thing for these operators to handle.
Okay. And moving on to slide 10, what other forms of financial assurance are available besides surety bonds?
Right now, it appears that New Mexico allows letters of credit, which are usually 100% collateralized, and those are documents that are given to the state by financial institutions other than insurance companies. And there are also cash bonds. Other types do exist, but most of them tie up and make operational capital less available to the operator. Now, when there's lines of credit, an operator ties up part or all of the line of credit available to them from their bank. When they post a cash certificate, those funds are removed from the account of the operator and moved to that cash bond location.
Okay. Now, moving on to slide 11, how would applicants' proposed rules tie up operator capital?
When, and I've had one surety tell me currently that, and I expected this, I had one surety tell me that they hadn't before, but they're going to start asking for collateral. When a surety asks for collateral, they are doing the same thing as a bank would do. They remove those funds from the operator. And when they do that, they could hamstring the operator. They won't do that knowing the operator is going to be hamstrung. But as always, when you do these things, there are unintended consequences, and sometimes that will happen.
Okay. And moving on to slide 12, how does the non-cancelable nature of New Mexico's bonds amplify underwriting risk?
It is known, non-cancelable bonds I'm talking about in a general sense, are generally considered very hazardous. And when there is an additive framework of blanket and single well, as the exposure increases, the more onerous that bond is or those bonds are to the surety. And if it increases enough, as these rules would indicate that they would, it will trigger in the surety re-underwriting of that account, the operator, and collateral increases or creation of collateral requests.
Okay. So you've already touched on New Mexico's non-cancelable bonds. Moving on to slide 13, how does this translate to higher premiums and collateral demands?
The only thing that increases the premium is the increase in bond amount for surety bonds. Of course, if there's changes in the operator, if the surety has ridden it for a long time, there are other conditions that can increase the premium when the credits they had been given before are removed and you get close to more of a manual premium for that particular bond for that particular operator.
Do some surety companies offer certain companies preferred rates?
When I was writing these, only the best qualified people got the highest credits available. There were categories of credits available for me to use, and very few got the all of the credits available. You could discount a premium as much as 50%. And I personally never had that premium credited to any account that I handled.
Okay. And is the surety market a competitive one?
It can be.
Would the proposals from applicants impact the competitiveness of the market in New Mexico?
It can. It's the linkage between the non-cancelable form and the increased limits of liability. That will reduce the number of sureties willing to write those bonds. I don't know how many there will be, but some that New Mexico has approved from the Treasury list don't write bonds, and others who had been writing bonds will choose not to in New Mexico.
Thank you, Mr. Emmerich. Now let's move on to a deeper discussion on collateral, capital, and premium, starting with your slide 14. Explain in greater detail the role that collateral plays in actually securing a surety bond.
Okay. When you write a bond, the principal on the bond, which would in this case be an operator, will sign an indemnity agreement. And again, the indemnity agreement makes it clear to the operator that the surety will expect to be paid back if there's any loss. Two, at all times during the underwriting process, the surety will look at the financials of the operator and determine if their working capital is sufficient to provide enough working capital to do the number of wells they're suggesting to do. And the typical underwriting benchmark is around 25% or greater of the bond amount, at least in working capital, and they like it higher.
Okay, and Emmerich, in the interest of time, let's skip ahead to slide 18. Can you tell the commission a little bit more about the types of collateral that sureties typically require?
Sureties will generally require cash deposits. If the full amounts are not available, they will ask just like New Mexico does, irrevocable letters of credits, which will tie up, as we said before, the credit lines for that operator. Those two categories are the two primary ones that sureties will consider.
Okay.
There,
And
there will be
collateral-
pledged assets that on a case-by-case basis that might be accepted, but that's a rare thing. If because a bond might be forfeited, they want assets to be easily turned over, and not all assets are.
Do collateral requirements affect smaller operators differently than larger operators?
There are some sureties that will write an operator that no one else will, and those are for hard to place bonds. And if you have several operators needing extra bonds, and small and medium-sized operators are most likely, if no one else is, to be hit with collateral requirements, because those balance sheets aren't as bulletproof as the larger operators are.
Okay. And on slide 19, you discuss premium ranges. What are the premium ranges that you're seeing in today's surety market?
Today's, and I didn't include originally the surety writers that cater to poor businesses, but generally speaking, the market range is 1% to 10%, and small and medium-sized operators can be in that 1% area, but more typically in the 2.5% to 5% range. Large operators get the lowest rates due to strong balance sheets. And as I said before, premiums increase when collateral or regulatory risk increases. And sureties pass the cost of risk through operators via higher rates.
Very good. Let's move on to the feasibility of the applicant's proposals and how the market might react. Starting with your slide 21, based on your experience, is the current surety market capable of absorbing the sweeping new bonding requirements that are being proposed?
Capable, probably yes. Not willing to do it is more likely. The thought that an operator, before he is approved for drilling, must provide that $150,000 bond on the one well he wants to transfer to someone else. Once sureties find out that that is happening, they are less likely to write bonds in that particular situation, because if everything goes according to Hoyle, that $150,000 bond, once that well is transferred and that new owner provides the bond necessary, New Mexico is likely to release that bond, but then the surety will be responsible for returning the premium for the amount of time that that bond was not in effect, because these premiums are annual. And they will be less likely to do that, because that's a lot of work for a little bit of money.
Okay. And moving on to slide 22, can you explain to the commission your view on whether what applicants propose is problematic?
And I mentioned it before, and for requiring $150,000 for each active well, in addition to the marginal wells, that I don't see an easy road for operators and therefore New Mexico to get that done easily, because each operator has to qualify for those higher amounts, which includes the re-underwriting process. So there's time involved and the possible likelihood that the surety will just turn it down, and there isn't enough collateral available to guarantee those bonds for the surety, so they'll decline it.
Okay. And does the non-cancelable nature of New Mexico's bonds have an impact on this situation?
Absolutely. First of all, you have to understand that the surety approaches this bond as very hazardous. And that is because the surety cannot cancel it. No matter what happens to the operator, no matter what happens to the economy, they cannot cancel that bond. And that's the biggest thing that influences surety's behavior on these particular types of bonds. If the surety had its heart's desire on writing bonds, they would never write a non-cancelable bond. That's how hazardous it can be.
When you say hazardous, what do you mean by that?
Simply, they can't get off of it. No matter what happens in the world, no matter what happens to the operator, if anything happens that affects that particular operator's abilities to continue, the surety cannot get off the bond. And that's not the game that most sureties want to play.
Okay. Now let's move on to your next slide, which reviews inactive and temporarily abandoned wells. How would applicants' proposals affect those types of wells?
It's the same thing as we've been discussing. The potential for misclassifying wells as marginal is very likely. And I can't tell you how many wells are going to be misclassified, but I guarantee you, because nobody's perfect, if nothing else, and wells that aren't marginal will be classified as marginal. And I think that is something the operators have to be prepared for.
Okay.
It reduces the risk-based tiers that previously existed with 150 per well arrangement. And that's, again, going to be a very, very tough ask of sureties to do.
So you mentioned this flat $150,000 rate, and on slide 25, can you explain whether this would be manageable for the surety market if the commission adopts this proposal?
When you say manageable, I'd rather characterize it as the sureties can manage it, but I don't think New Mexico is going to like how they choose to manage it. Imagine a multi-well operation asking for 10 or 15 marginal well $150,000 bonds, as opposed to the single blanket bond or lower amounts. The surety will have to re-underwrite, and it's just, as far as New Mexico's looking at it, a luck of the draw on which ones they will approve and which ones they will decline.
All right, thank you. Let's move on to a case study that you provided in your testimony. I believe it's called the W&T offshore case. Can you explain the significance of this case and what happens in practice when regulators impose across-the-board increases?
Well, that was an interesting matter that I became aware of, and it's a federal bond, which is also non-cancelable. So the sureties are going to look at that as just like the New Mexico bond. It's non-cancelable. And the sureties, because of alleged changes in W&T's financials, as well as the regulatory environment, court decisions, and legislative changes, they asked for additional collateral. As we had indicated before, these increases of collateral may go from 50 to 100% or 25 to 75%. It just depends on the particular situation. And the same things can happen in New Mexico. Collateral requests will happen. Increases in collateral will be requested. All of this, and it's a very good case study of what happens when the landscape changes for the surety. The surety needs to underwrite to a zero loss ratio, and they increase the collateral to ensure that the lead surety and the co-sureties will have a zero loss ratio. And but basically that's what the case is.
Okay. Did you hear Commissioner Bloom's question about the impact of, I guess, what happened in W&T, in the W&T case on the overall market earlier in this proceeding?
I'm not sure I did.
Okay. Let me ask you this way. Is the significance of the W&T case to this proceeding the fact that both dealt with non-cancelable bonds?
That is the big similarity.
Okay.
That is the prime similarity. And again, collateralization of the bond is what is at the root of this case, and the non-cancelable provision of the bond is the thing that helped make the sureties decide that collateral was necessary.
Okay. Did you hear the testimony of Welk's witness, Peter Morgan?
Yes.
He said that this was an antitrust case. Is that accurate? And if so, what is the significance?
I'm sorry. I kind of laughed when I heard him say that, because it is far from an antitrust case. These bonds were big, and the size of the bonds themselves don't make the situation any differently than what New Mexico is going to face on the bond amounts that they have. It's the same situation because of the non-cancelable bond and the zero loss ratio approach of sureties. It is not an antitrust case because there were co-sureties on these bonds. I don't know whether there were one or two, possibly three sureties on these large bonds. And when sureties are sharing the liability of that bond, each surety has the responsibility to get the information that the lead surety has. So that happens with every single co-surety ever written. Each surety knows just as much as the other surety. And to call that antitrust just doesn't make any sense.
Okay, let's move on to your slide 30. You're aware that applicants are proposing to change certain definitions through this rulemaking, correct?
Correct.
Now, on slide 30, you discussed some of those changes. Can you please explain the significance and your concerns?
Well, some of the marginal well and beneficial use definitions can be vague and subjective, which will lead to inconsistent application. And again, when marginal is defined, there will be misclassification of some marginal wells. Don't know how many, but there will be. And it creates unpredictable bonding obligations and an unpredictable underwriting risk. And when sureties face that, they will decline to write, because if they can't predict it, they will not write it.
Okay, let's move on to your next slide. Let's start with marginal well. What are your concerns with that definition?
The definition itself, I wasn't worried that much, and I can't talk about BOEs and that kind of thing, but the provision that puts a $150,000 bond onto productive wells, it's what bothers me the most. Good wells shouldn't be penalized for what the state is calling bad wells. And forgive my terming it of that, but it's almost like punishing an operator for having too many marginal wells. And I don't know that that is the right way to approach this. It inflates the liability that sureties have to underwrite, and it eliminates the link between economic performance and risk. But beside that, it distorts liability and bonding metrics that the sureties had expected up until this point.
Mr. Emmert, let's move on to your slide 33, which is another definitional change that's proposed, dealing with presumption of no beneficial use. Can you explain how that would work and why it matters from a surety standpoint?
From a surety standpoint, the sureties need to know that the operators they are writing have a clear window on what they're supposed to do. And I see possible difficulties for operators. And when the status of a well can change, and that causes volatile bonding demands, that's going to upset a lot of sureties. Again, because if they write a bond, they want to continue on that bond at least for a year. And if they can't, if it's released early because of a new bonding request, they will lose premium that they were expecting. And also, even if they get more premium for the additional bond, the potential is that sureties will actually decline to write the larger bonds. And this 30-day rebuttal window, it's a challenging operational thing to consider, and I would expect a little bit of chaos for the reporting and the decision-making process.
Now, does this presumption of no beneficial use utilize or rely on any sort of economic principles to your knowledge?
Not that I saw.
Okay. Now let's move on to what some other states are doing, starting with slide 35. Do other jurisdictions use a marginal well definition for purposes of bonding?
I don't think they do, but the types, the sizes of bonds are very different than what's seen here.
Can you tell us how other major oil producing states handle financial assurances for oil and gas wells?
Well, Texas, for instance, puts a $25,000 bond for operations that have 1 to 10 wells and a $250,000 bond on an operation that has 100 wells. There are no production level or marginal well definitions attached to those as far as I know.
Do you know if Texas's bonds are cancelable or non-cancelable?
Yes, they're cancelable. They actually terminate.
Okay. And moving to slide 36, in your view, would adopting applicants' proposals have any sort of impact on New Mexico's competitiveness with other states?
I think it would. When Texas is increasing bond amounts, that is the potential here, on a lot of wells, that is a very different approach than the surrounding states take. And I expect some operators to flee the state and go to neighboring states. Because the states I mentioned have cancelable bonds. Colorado is a continuous bond, just like New Mexico. So I don't know that they'll go to Colorado, but Texas, Oklahoma, and Louisiana are potentials.
Okay. Skipping forward to slide 38, let's move on to your testimony regarding administrative and enforcement types of issues. Have you identified any administrative problems that might be foreseeable if the commission adopts applicants' proposed framework?
The biggest change that I saw is when operations are selling wells, and for the requirement of the 150,000 bond, single well bond on the well they want to sell before they transfer it to the new owner. I think will become unworkable because sureties, once they find out that they will have the bond for 2 to 3 months, 3 months, 4 months, 5 months, however long the transfer takes, and the new owner may get the surety bond from another surety. I don't see that as being a very smooth transfer.
Okay. Now let's move on to your slide 40, which discusses blanket bonds. How do existing blanket bonds work in comparison to these single well financial assurances that are proposed?
Yeah, that's pretty simple. Blanket bonds cover the specified wells that the operator owns. Single well bonds cover only one well, however many the operator has. And when blanket bonds are issued, the surety has one amount to consider, one underwriting process. When the single well bonds are introduced into that environment, that causes the surety re-underwriting on every operator that is being asked for the single well bonds.
So just to conclude this section in your testimony, can you please summarize the practical impact of these definitional and administrative proposals on the market?
Well, I see disruption in the surety market in the short term. Operationally, it will become less predictable. And over the long term, I see the OCD overburdened by continuous recalculations of these amounts. And I think that alone will take away from the OCD's necessity on oversight and the non-reporting of wells that Mr. Powell talked about. That I don't think that is what is the proper purpose of the OCD, is to recalculate bond amounts. There will be change premiums from sureties to the operators, and it's going to be a very difficult process to manage.
All right. Well, we told the
And
commissioners.
I'm sorry, the commissioners?
Yeah, let's move on to your next slide in the interest of time. I think you covered that, and so we really appreciate your testimony. But we told the commissioners that we'd provide some examples of alternatives or better approaches. So starting with slide
Certainly.
42, what are some workable alternatives that might better achieve the state's goals?
I think that they should retain a risk-based tiered blanket bond framework. That matches up the risk and security in handling these operators, and it makes more sense. And I think most important is phasing in any new bonding levels. And I'm not denying that new bonding levels may be necessary, it's just how it's done, is phase in any new bonding levels gradually. That will soften the blow to the surety industry and increase the likelihood that sureties will react favorably to these new rules. Expand the approved assurance forms, including decommissioning or plug and abandon trusts, and third-party guarantees also. These third-party guarantees and protections can be put in to protect New Mexico, but both are good options for the OCD to consider. And always, this is with an eye to avoid market shock while maintaining environmental protection. And it aligns more closely to successful state models like Texas, Oklahoma, and Louisiana, including Colorado.
So there's a lot in that slide. Let's unpack some of that a little bit. How do the trust accounts that you just mentioned compare in terms of security and flexibility to surety bonds?
Well, surety bonds are have a particular amount associated with each one, and that is what is required by statute, and that's what the bond is for, and that's what the surety considers. Trust accounts hold funds at all times available for that decommissioning. And these can be funded incrementally over time. They are transparent and regulator accessible. It also reduces the risk of the rare surety or insurer default. And
All
it
right.
also is a benefit to the operator because it avoids large upfront capital freezing.
Very good. Let's move on to third-party guarantees, which you mentioned. Can you explain how third-party guarantees work, please?
Certainly. Just like indemnity agreements work, third-party guarantees are promises of well-endowed relatives and others can guarantee to provide funds if they are told what the exposures are. It can be a parent or an affiliate operation, and many small operators have those kind of people that can offer their guarantee for their operations. It increases market participation and surety diversity. Right now, New Mexico, from one report I saw, has about 70% of the financial assurance provided by surety companies. This will increase that market participation and reduces orphan well risk without harming independence. It broadens financial assurance options for New Mexico.
And moving on to your next slide, in your opinion, should New Mexico retain its risk-based model and tiered blanket bonding system instead of adopting a one-size-fits-all sort of model?
The one-size-fits-all model that the 150,000 single well bond represents is problematic, and maintaining risk-based tiers, you're actually aligning coverage with actual exposure, and it may preserve liquidity for responsible operators and encourages investment and avoids overbonding. That's an important point. Protects small and medium-sized operators from exclusion and replacing it would reduce competition and revenues, possibly.
All right, and moving on to your next slide, can bond instruments be rewritten to make them more workable and maybe even be able to convert them to a periodically renewed sort of form?
Certainly. It's not uncommon to have a renewable form in this type of bond, and a lot of bonds, a lot of license bonds have cancellation provisions. You can make it continuous for a 2-year renewable period, but it does end after 2 years, and the surety can renew it or a new surety can write it. And it will expand surety underwriting eligibility. When the exposures are understandable and sureties can put their arms around a particular risk and understand it properly, they are much more willing to write it. And it simplifies the approval for non-cancelable bond exceptions. Aligns New Mexico with bond industry norms and reduces market barriers while keeping accountability.
Okay. And the last slide in this section of your testimony, in your view, would these reforms still protect the state if an operator defaults?
There would be no change in protection for New Mexico. It retains full state protection. The New Mexico bond actually goes to the obligee is the state of New Mexico for use by the Oil Conservation Division. That would remain the same. Ensures bonding availability and prevents stranded assets that are possible, and reduce orphan well risk through market stability, and it will support a strong operator and surety base in New Mexico.
All right. Now, Mr. Emmerich, I'm going to move on to your slide 53 so you can go over your closing observations and recommendations. If the commission decides to move forward with the proposals at issue in this proceeding, what recommendations do you make to them?
Well, and we've touched on some of these before. Retain risk-based tiered blanket bonds. I think that is a very effective way to do this. And phase in increases to prevent collateral shocks. And thirdly, adopt a BOE-EM style safety valve. And that means that allow the division to deviate from prescribed amounts where the operator demonstrates that the amount on file at least equals the estimated decommissioning cost. Get into talks with the operators, and this will go very, very easily. And use creditworthiness and reserve exemptions like CFR section 556.901. Allow consideration of the value of the reserves for the well that the well is producing and the creditworthiness of the operator or its other co-interest holders in the well. Also, authorize additional proven assurance forms, which we just talked about. Plugging in abandonment trust accounts and third-party guarantees with appropriate case safeguards to New Mexico. Diversify capacity while protecting the state. And clarify the scope and effect of the new definitions. If any definitional amendments are adopted, specify their limited application to avoid open-end financial assurance triggers. I don't know whether anybody realizes this, but beneficial use is used in the New Mexico bond form. And that carryover to the bond itself, I haven't really examined it, but it will be interesting to see how that affects the bond.
Very good. And why would these specific reforms, in your opinion, work better than what applicants have proposed?
What I propose builds on what New Mexico's existing functional framework. It keeps market participation strong and surety capacity more available, provides clear standards and risk-based coverage, and avoids as much as possible collateral calls and unintended orphan well growth, protects both the environment and state revenues.
All right, and moving on to your next slide, what lessons should the commission draw from other regulatory models such as BOEM or other peer states?
In the peer states, it's most important to understand how many states offer a cancelable bond form. It's an effective way to handle the plugging and abandonment bond, and I think it needs to be maintained on a risk-based, flexible bonding framework as it is now. It doesn't have to be exactly the same amounts, but the tiered-based approach still works. Allow operator-specific deviations when coverage is sufficient. Permit multiple assurance forms and provide stability and participation without weakening oversight. Oversight is very important. New Mexico can adopt best practices while retaining strengths, and they can learn from Texas and Oklahoma and other templates.
Okay, and your next slide, 56, what are your closing observations to the commission on New Mexico's current framework?
I would prefer that they strengthen what is already working. Current system balances protection and practicality. Reform should improve, not overhaul, effective tools. And lead by example. Strong environment, strong economy. Keep New Mexico competitive and responsible, and align with real-world cost, capacity, and experience, and knowledge that you're dealing with a surety operation that is not at all like insurance.
And your final slide. What are your recommendations to the commission with respect to applicants' proposals?
I would suggest strike or revise Welk's proposed marginal well, FA requirements, preserve existing blanket bond concepts, implement a risk-based bonding system for single well FA if you deem it necessary, and if necessary, the financial assurance to New Mexico's specific index rather than the consumer price index. Modify bond instruments via periodically renewable form.
Thank you, Mr. Emmerich. Madam Hearing Officer, that completes our direct and rebuttal. We do have a fair amount of rebuttal slides. I don't know if you feel like, since it's just after lunch, if we should take a short break here or if you want us to continue.
But I would continue a bit, yeah.
I would actually benefit from 5 minutes, so
I'm
a
sure.
short one would be great if I could.
All right, well, let's just come back at 2 then.
Oh.
Excuse me. Scratch.
This is over.
I'm sure you will.
You haven't hugged me when I'm in a suit in a long time.
That's true. Let's come back from the break, please. There's Mr. Emmerich. All right, Mr. Swazo.
Thank you, Madam Hearing Officer. Mr. Emmerich, we're going to start with your sir rebuttal testimony. Have you been observing this rulemaking proceeding thus far?
For the most part, yes.
Okay. And in response to applicant's expert testimony, are there any additional remarks to the commission made by those experts that you would like to address in your sir rebuttal?
I think there is.
All right. Let's move on to your third slide, which deals with Welk's technical expert, Thomas Alexander.
Yes, I thought it interesting that Mr. Alexander admitted the financial insurance rules that are put forth will affect every operator. And if the new rules, he also noted that if the new rules are put in place, there will be small and medium operators that will forfeit any existing bonds and not be able to provide larger ones, which is basically what I've been saying here. OCD may grow their orphan well problem as a result. We will see. Mr. Alexander admitted speculation in one of the definitions was confusing and the new rules need to be interpreted. And with every interpretation, there comes confusion and uneven handling. It amplifies confusion and perceived risk in the surety underwriting process as well.
All right, and moving on to slide 4. What about applicant's other technical witness, Mr. Dwayne Purvis?
Well, I noted that when the commission was questioning Mr. Purvis, there were some answers he gave that were flat wrong, and it was clear to me he had no surety underwriting experience. He said that collateral with the principal was being done because the principal was a poor risk. That is wrong. Collateral is taken by surety even if the principal is good. Remember, surety is written to a zero underwriting process. The zero underwriting process has no friends. That is what surety should do. And I don't think Mr. Purvis understood that. Mr. Purvis also told the commission that bonds were written for 1 year. Now, I'm really surprised there weren't any comments heard after that, because in New Mexico, that is just flat wrong. Premiums are paid once a year to the surety, but the bond is continuous in nature, is non-cancelable. Purvis may have been thinking of annual premiums, but premiums have nothing to do with the term of the bond. Annual premiums are charged even on non-cancelable bonds.
All right, and let's move on to slide 5. Applicant's legal expert and self-proclaimed financial assurance expert, Peter Morgan. What is your response to his testimony?
Well, I noted that he was forced to reveal that he was never worked for surety or has no surety experience and never has issued a bond. That is part of being a financial assurance expert, and he didn't have that experience. Mr. Morgan compared New Mexico to how the increase in financial assurance affected Texas, but he never looked at the bond form. How it affects New Mexico is going to be different than it affects Texas, because Texas is written on a cancelable, terminable bond. Texas, by the nature of the bond, is a less hazardous bond to write. Mr. Morgan's statement during the commission questioning said prudent operators will be rewarded by sureties with good terms. That's wrong. It does not matter. Prudent operators have to be financially stable and have to be a lot of other things, including a good operator and someone who follows the rules. Mr. Morgan said that the state of New Mexico spent $15 million plugging 193 wells. That's over a 5-year period, and that works out to an average P&A cost of $77,720 per well. Now, I can't understand why there is such a difference in what the OCD is saying now, that the average cost is 163, because they themselves spent just 77,720 per well. And that needs to be explained.
All right, moving on to your next slide. Applicant subject matter expert Adam Peltz. What is your reaction to his testimony?
Well, Peltz even admitted that financial assurance should be risk-based. And if the high-risk operator portfolio category and the thresholds are adopted, OCD should have discretion to waive the single well financial insurance for all wells, regardless of status of type. And I don't see that in the rules. Mr. Peltz admitted under the rules as currently proposed, 19, 15, 8, 9, D3, and MAC, there is no ability for OCD to waive the agreement requirement that all wells be secured by $150,000 worth of assurance when an operator has 15% or more marginal or inactive wells. And that is designated as a high-risk portfolio. At a minimum, I think the 15% threshold should be increased, as Mr. Peltz indicated, would be reasonable if clear limitations are established.
All right, thank you, Mr. Emmerich. Do you have any other overarching concerns with applicants' remarks to the commission?
My overarching concern is that the WELC and OCD mindsets appear to desire to eliminate the small operator, who they view as the perpetrator of New Mexico's orphan well problem. I don't know whether that's true, but without proof of the same, that's what their actions appear to say. The unasked questions about these rules is if the current OCD couldn't keep orphan wells from occurring, what makes them think the new rules will? And I don't think in today's environment that they will be able to staff up properly their personnel very easily. There will be phone calls, emails, and possibly letters about these new rules when they are implemented that will drive OCD crazy.
Let's move on to another witness in this proceeding, the Bureau Chief, Ms. Rosa Romero. Are there any remarks made to the commission by Ms. Romero that you want to address?
Yeah, I just want to call their attention to Ms. Romero's confirmation that the remediation and reclamation costs are not included under the financial insurance authorized other than the New Mexico Oil and Gas Act at issue here. The remediation examples provided by Ms. Romero were also not instructive here because it is unknown what financial insurance was in place on the wells she discussed. She also admitted that the remediation and reclamation costs she reported represent such a small sample size that they cannot be used to determine what the average cost would be to perform any statistical analysis. And similarly, the program she was talking about just started in 2023.
All right, let's move on to your next slide, which addresses some of the remarks made by Deputy Director Powell, who oversees OCD's engineering and environmental divisions. What are your concerns regarding forfeiture?
Well, it was stated at some point in this hearing that bonds hadn't been forfeited by the OCD since 2018. And that is an issue because some of the data I've seen since somebody made that statement indicates that that simply is not true. But in any case, this may endanger some operators with multiple bond requests, possibly force them out of the business because of the amount of bonds requested. And some people may consider this a governmental attack on its constituency, particularly that marginal well rule that requires bonding of all wells of that operator. These rules shouldn't be changed until the state of New Mexico knows what forfeiture the bonds would generate in total. And if the $250,000 blanket bonds are not worth forfeiting, how are 150,000 single well bonds going to change that?
All right, next slide. You had an interesting note about the operator analyses that OCD would have to undertake and how that may incorrectly place the agency in place of the private surety provider. Is that accurate?
Yes, I think it is. I think some of the things I've said today will make it clear to the OCC and the OCD that the surety does a deep dive on their principles that they underwrite. And the financial assurance rules cover the state, and the surety underwriters will have to perform their same analysis before providing the bond to the operator. And therefore, for all surety bond providers for the state, I don't think it is the good use of OCD's time to do a deep dive on those operators. They have a lot of other things to concern themselves with, and they don't need to be doing that because the sureties are already doing it.
Okay, let's move on to your next slide. Do you have any comments in regard to SLO witness Allison Marks?
Yes. The State Land Office discussed the use of OCD bond proceeds. As far as surety provided funds through forfeiture, this could only happen when OCD received funds from the surety. No surety with this bond form will pay the State Land Office on an OCD bond. They will not do it. The surety will only pay either the state of New Mexico or the OCD. And the OCD is the obligee along the state of New Mexico on the bond as the only entity the surety will pay.
All right, thank you. Next slide, please. Next slide. I think you wanted to add a little more color on the non-cancelable bond in New Mexico. Can you please elaborate?
Well, keep in mind that non-cancelable means that there is no cancellation provision in the bond. Its absence is what makes the cancellation provision is what makes the bond cancelable. And it is missing. I shouldn't say that. It's not present in the New Mexico bond. The surety cannot cancel the bond once it's issued. And if the regulatory environment and risk change, the surety still cannot cancel that bond. Using a replacement non-cancel bond, unless a replacement non-cancelable bond is on file. And non-cancelable bonds are inherently a riskier bond to write. It is written in surety training documents that non-cancelable bonds are highly hazardous. And finally, sureties perform deeper financial analysis than for a cancelable bond.
All right, and I think you had some additional examples starting with the next slide. You provided some examples for the commission to review, what are you showing on this slide?
This is a very interesting bond form. On the left-hand side, you see a gray box on the right that says this bond is continuous, and that's simply not true. Because when you read the bond terms, and I've highlighted the part, it allows this bond to be canceled. Plain and simply, those are the terms of the bond.
All right, next slide. What does this show?
For Louisiana, the same thing. The provision highlighted is the provision that allows a surety to cancel the bond.
Okay, and another example, I think in Texas on the next slide.
Yes, this particular provision is the one that terminates the bond on a date filled in the blank in the highlighted area. And I didn't highlight it, but there is also a cancellation provision in this bond.
Okay, next slide, please. What does this slide show with respect to New Mexico's bond forms?
Well, it's only the first page, but when you get to the bond terms on the second page of this bond form, it's a simple fact that there is no cancellation provision in this bond form, and that's what makes it non-cancelable.
Does this more clearly show what you're?
That's it. That's it. So if you would scroll through the entire bond form, at nowhere, in fact, the last paragraph, then and in that event, this obligation shall be null and void otherwise, and in default of complete compliance with all of the obligations, this shall remain in full force and effect. The last paragraph makes it very clear that this is non-cancelable. Plus, it's missing the cancellation provision.
All right. Anything else you want to add, or can we move to the next slide?
We can move to the next slide.
What would you like the commission to see about this slide on federal offshore bond forms?
Federal offshore bond forms are very different, but again, the cancellation provision that would allow this bond to be canceled by the surety is not anywhere in this bond form. And that, again, is what makes the bond non-cancelable.
All right, next slide. Now, I would like to take us back to the W&T case because I think it's going to be brought up later, and I want to be clear about what your assessment of that case is and the applicability to the current proceeding.
Okay.
Can you please walk us through this case based on your slide 23?
Well, I think it's a case study for non-cancelable financial assurance. This case is used to substantiate the efforts I anticipate will happen here in New Mexico because of the non-cancelable bond form of New Mexico. And it proves collateral and premiums could be increased by sureties as a result of a financial insurance overhaul and increasing in bond amounts. Proves existing bonds will be affected in addition to the new bonds. If the exposure of the operator becomes affected by these additional single well bonds, that's when the surety may change its approach to the account and take action of collateral or having another surety take over its responsibility. It proves that for existing non-cancelable bonds, sureties can strategically demand amount increases of collateral to escape hostile and/or risky regulatory markets.
All right, and on the next slide, you discuss in greater detail how New Mexico and the federal offshore bonding requirements are, run in parallel in terms of form and in terms of the regulatory regime that supports them. Can you explain that for the commission, please?
Certainly. As said, the New Mexico bond form and the federal offshore bonds are both non-cancelable because they cannot be released by cancellation by the surety until the full terms of the lease, grant, or permit obligations are met, or replacement non-cancelable assurance provided, including all plugging and abandonment requirements. Regulations reflect the non-cancelable bond form too. New Mexico regulators seeing both financial assurance and plugging and abandonment is the OCD. Federal offshore regulators seeing overseeing financial assurance is the Bureau of Ocean Energy Management, and federal offshore overseeing plugging and abandonment is the Bureau of Safety and Environmental Enforcement.
Okay, next slide. So this is the rule 1915-812. Can you explain why you want the commission to focus on this particular rule in this context?
This provision provides OCD with the capability to release a financial insurance upon the operator's or the surety's written request if all wells drilled or acquired under the financial insurance have been plugged and abandoned. And that is what is the reason the non-cancelable provision is not in that bond form, or that's why it was put in. It's not necessary that it's put in, that it's not put in, but it's why it was that cancellation provision is not in the bond form.
Okay, next slide. And I guess this is by way of comparison. Can you please walk us through
Right.
this slide?
Yep. Both the BSEE and the BOEM, the BSEE states lessees must permanently plug all wells on a lease within 1 year after the lease terminates. And the BOEM states the provisions that allow release for the sureties, different types of sureties on the BOEM side.
Okay, just a few more slides left. Let's move to slide 27. Now, I think you identified some language for Mr. Morgan that indicated that a mechanism allowing replacement of bonds might change this. What is your response?
That's hard for me to read. I'm sorry. Oh, this is on the W&T case. He indicated that it was, I misidentified financial concerns, and that's not the only thing that the sureties were considering. There were other aspects of the underwriting environment that bothered them as much as whatever W&T's financials caused. And he was wrong to cite that.
Sorry, I think we're on the wrong slide. Apologies. To your knowledge, was this complaint amended?
Yes.
And that amended complaint is attached to your rebuttal as Appendix A and B, correct?
Correct.
Okay. And to your knowledge, W&T's claims against Lexon and Endurance are still pending, is that right?
Correct.
Now, also on slide 29, Mr. Morgan focuses on Lexon's partial motion to dismiss, which is document 57 in the Pacer docket in this case that is pending. What is your response to Lexon's remarks here?
Well, Lexon actually says that financial status was one consideration, but also industry-wide situations such as court rulings, industry losses, and reinsurance considerations were also involved in their decision to increase the collateral.
Okay, and on your next slide, sorry, slide 31. Just to clarify for the record, Lexon was not one of the sureties that settled with W&T. Is that accurate?
I think that's right.
Okay. And that's evidenced by the court documents that we're looking at on these next two slides?
Right. The jury trial is scheduled for February 2027.
Okay. And I think that brings us to the end of your sir rebuttal testimony. Mr. Emmerich, is there anything else you'd like to add that I might have omitted?
No, I don't think so.
All right. Well, we certainly appreciate your time and your testimony in this proceeding. Madam Hearing Officer, at this time, NMOGA moves to admit the testimony, rebuttal testimony, the appendices, the demonstrative exhibits, and the summary of his direct and sir rebuttal testimony into the record.
Pause for a moment in the event there are any objections. Oh, they're admitted. Thank you. Ms. Fox or Ms. O'Grady, do you have any questions of Mr. Emmerich?
We do, thank you. Mr. Emmerich, good afternoon. How are you?
I'm doing fine, thank you.
Great, glad to hear it. My name is Morgan O'Grady. I'm an attorney with the Western Environmental Law Center for applicants. I'd like to start with the W&T litigation. Mr. Emmerich, you testified this afternoon that you were surprised to hear Mr. Morgan refer to the W&T case as an antitrust case, correct?
Yes.
And you testified that the W&T case is not an antitrust case?
No, I characterized it as it can't be antitrust because of the arrangement of the sureties and that there cannot be antitrust on a co-surety arrangement.
But you would agree that the case, it does include a listed count of a violation of the Sherman Antitrust Act?
It may, yep.
And that on page 3 of the complaint, which is Appendix C to your rebuttal, the complaint alleges that the surety scheme violates federal and state antitrust law?
Yes.
Great, thank you. I'll move on. Mr. Everhart, would you please pull up Mr. Emmerich's slide number 42? Thank you so much. Really appreciate it. Oh, on the direct and rebuttal, I believe was one PDF. The version that was pre-filed did not have page numbers, so, but I think it was 42 of the direct and rebuttal. Perfect, thank you. Mr. Emmerich, you haven't proposed specific language for your proposals, have you?
No.
You haven't proposed specific bonding levels?
No, I wasn't asked to do that.
And you haven't proposed graduated bonding levels?
No.
Are you aware that if parties are to propose amendments to the proposed rules, they were required to submit those proposed amendments with their direct and rebuttal testimony?
I am not aware of the rules of these proceedings or the rulemaking in New Mexico. If you say so, I trust it.
Okay, thank you. Mr. Everhart, would you mind turning to slide 45, please? Thank you. Mr. Emmerich, on this slide, you testify that you endorse various alternative forms of financial assurance, such as decommissioning, trust accounts, and third-party guarantees, correct?
Correct.
Oh, actually, can we jump back to 42, please? No, I think 45 was correct. Thank you so much. Apologies. Are you familiar, Mr. Emmerich, with the New Mexico Oil and Gas Act's provision on financial assurance at NMSA 7D214?
No, I don't believe I read that.
Okay, I am going to take over sharing the screen. Here is the New Mexico statute on financial assurance. Are you familiar with the provision, or how would I read the provision as you indicated you're not familiar with this statute? The statute specifies that each person, firm, corporation, or association who operates any oil, gas, or service well within the state shall, as a condition precedent to drilling or producing the well, furnish financial assurance in the form of an irrevocable letter of credit or a cash or surety bond or a well-specific plugging insurance policy. And then it goes on. Did I
Yep.
read that correctly?
You did indeed.
Do you agree that the statute limits what forms of financial assurance the commission may allow by rule?
It does.
Do you agree that the statute does not list third-party guarantees?
Correct.
And third-party guarantees would therefore require a statutory change, correct?
Correct.
Okay. Mr. Everhart, can I trouble you to turn back to slide 53, please?
We can bill as time to you for this one.
Yeah, absolutely. Thank you so much. Would adopting a BOEM-style safety valve require a statutory change, Mr. Emmerich?
I do not know.
Would the use of creditworthiness or reserve exemptions require a statutory change?
I do not know.
Would the authorization of trust accounts and, as just discussed, third-party guarantees require a statutory change?
I do not know.
And you haven't proposed any specific language for any of the proposals listed on this slide, correct?
I think I've already answered that.
Not for this slide, I don't believe.
Not for this slide, correct.
Okay.
No, I have not provided any language for any slide subject.
Okay. Last request, Mr. Everhart, would you please pull up slide 47 of the direct rebuttal? Perfect. Mr. Emmerich, you testify about the importance to the surety industry of non-cancelable bonds, correct?
Correct.
Okay. I'm going to take over sharing my screen, and this is my last line of questioning. So I'm jumping back to the statute here. And as we just discussed, the statute specifies various things for the financial assurance that must be provided, including that it must be irrevocable. Do you see that?
Yes.
Would you agree then that any change to the revocability of the financial assurance that may be required would require a change to the statute?
Well, the rules for the letter of credit in NAMIC indicates that it can be canceled.
Can you clarify in what?
In the definition of irrevocable letter of credit.
Sorry, can you repeat your original answer?
My original answer?
NMAC, oh, okay. So are you testifying that you believe that various existing rules allow for revocable financial assurance forms?
I don't know.
Can you point us towards any provisions in the current existing rules that allow for revocable financial assurance forms?
Not off the top of my head.
Okay, I have no further questions. Thank you so much for your time, Mr. Emmerich.
Certainly.
Thank you. Mr. Tremaine or Mr. Hall?
Thank you, Madam Hearing Officer. I have a few questions. Mr. Emmerich, my name's Michael Hall. I'm an attorney with the Oil Conservation Division. How are you?
I'm doing well. Thank you for asking.
Certainly. I was a little unsure about a couple of just kind of predicate matters. Did I understand that the extent of your oil and gas insurance and or underwriting experience was when you worked in Dallas?
No, it wasn't just while I was underwriting in Dallas. After I left Dallas, in a later stage, I audited offices and I audited surety underwriting for these types of bonds through the 1990s.
That was in the 1990s. When did you stop doing that?
1996.
Okay. And so since that time, you have not been involved other than as an expert witness with oil and gas underwriting?
That's correct.
Did you also, were you involved with plugging insurance contracts in your time working in oil and gas underwriting?
No.
Do you have any familiarity with that concept?
Well, as an insurance policy, I'm familiar with insurance policy, but not specifically that policy.
Okay. And is that why you haven't discussed that as a form of applicable form of financial assurance in New Mexico?
That's correct.
Do you agree that it is available as a form of financial assurance in New Mexico?
I don't like it. The claims process on insurance policies is very different than it is for surety. And I'm not as comfortable with providing insurance policy for these types of bonds.
Nevertheless, your comfort level notwithstanding that it is an available form of financial assurance in New Mexico?
Yes, I do know that it is.
However, those sorts of insurance policies don't have a zero loss policy attached to them or zero loss goal.
I wouldn't know.
Okay. Now, with regard to your testimony on oil and gas surety arrangements, would you agree that there are generally three parties to those?
For surety bonds, there always are, yes.
Okay. And in this case, it would be the operator, the state of New Mexico, and the surety, correct?
And the operator is what's known as the principal, as one of the parties, yes.
That would be the entity providing collateral and creditworthiness to the surety?
That is correct.
Now, and I don't want to quibble over semantics, but I believe you distinguish between insurance and surety arrangements in your testimony, correct?
Correct.
However, both of those shift risk, don't they?
Again, I can't speak to what the plugging insurance policy does because I don't know it. Surety, on the other hand, it does not shift necessarily the surety will act in place of the principal if the principal does not fulfill its responsibilities. Only at that point.
How does risk, excuse me, that was a bad start of a question. The risk absolutely shifts away from the state of New Mexico in that arrangement, correct?
Correct.
Did you rely extensively on Mr. Arthur's testimony to form your analysis and conclusions in this matter?
Not extensively. I did.
Did you cite to him more than 30
cite
times
to
in
him.
your direct and rebuttal testimony?
Yes.
You would not consider that extensive?
No.
Okay. What data did you rely on to form the basis of your testimony?
I wouldn't consider underwriting experience as data, but that's what I based a lot of my testimony on.
So this is exclusive, any data at all? I didn't quite understand. Or only your underwriting experience?
There may have been some data that I looked at, but I depended on my underwriting to reach my conclusions.
And again, that ended in 1996, is that correct?
Surety is a type of underwriting that has existed in the corporate environment since 1880. And those principles that guide underwriting have not changed significantly in that time. And that's why it's a reliable experience to base decisions on.
Sure. Okay. I just wanted to be clear. You might not have understood my question. Your experience ended in 1996 on that. Is that correct?
If that was the question, that is correct.
Okay. Do you know how many contractors and subcontractors operate in the oil and gas industry in New Mexico?
No.
Are you familiar with insurance or financial assurance with regard to operators and their subcontractors?
I understand underwriting of the principal of the bond.
Do other entities do work for operators?
They might.
Are there usually indemnity or insurance contracts, even bonding with those sorts of arrangements?
There's an indemnity agreement for every principal.
Objection. This goes beyond the scope of witnesses' testimony, I believe.
Is Mr. Hall?
I believe he went in depth about the basic functions of indemnity, financial assurance, and I'm probing that knowledge.
Overruled.
Would you like me to repeat my question, sir?
Yes, please.
Okay. I believe you said indemnity applies to all those agreements. Is that right?
I said with every bond, the principal signs an indemnity agreement.
And what's the purpose of that?
And I believe I stated this during my testimony when a surety asks for and receives an indemnity agreement. It is a promise for the principal to pay back to the surety any funds that the surety is made to pay because of, in this state, forfeiture of the bond.
And even with a two-party contract, say between an operator and a subcontractor doing work on a well, there would be indemnity or agreements to pay in the event of some default on that agreement, correct?
I would assume so, but I'm not talking about as an operator. I don't know specifically what they use.
A general principle of risk shifting is those sorts of agreements so that in this case, New Mexico is not left, the citizens of New Mexico are not left paying for operators who don't plug and abandon their wells, correct?
That's what the bond is for, to do exactly that.
Now, speaking of that, I believe you were saying you were confused about the 77,000 or approximately 77,000 amount that you thought it cost OCD to plug and abandon wells?
That was from a spreadsheet that I saw that had 5 years of spending from the reclamation fund to plug wells from 2019 to 2024, I do believe.
And I believe you said OCD needs to explain that. Is that right?
No, I said with that number and the 163,000 average that they have since stated is the average for plugging and abandonment. I don't know whether that's 1 year or 5 years of experience or 10 years of experience or just one single last year.
Well,
So
I'll represent.
the difference between the two has to be explained.
Sure. And I believe you said you'd listen to Mr. Powell. Is that right?
Yes.
Do you recall him saying the 163,000 is the fiscal year 24 OCD plugging costs average?
And if that's the case, then how do we get from 77,720 to 163,000?
I believe he explained that, and I'm sorry if you didn't hear it. But I guess I'm not here to explain that since he's already testified to that. Now, non-cancelable form, I wanted to explore that a little bit with you. These other states that do allow sureties to cancel their agreements, that subjects those states to risk, doesn't it?
Not necessarily.
Well, let's go through a hypothetical here. A surety cancels the bond. An operator goes bankrupt. What happens?
I don't know. There's lots of possibilities. That property could be taken over by another operator and bond supplied. I just don't know. It's hard to deal with hypothetical situations.
You've never seen that in your experience as a surety
No,
expert?
no.
One result of that would be a state that allowed sureties to cancel bonds would be required to pay the plugging costs, correct?
Not necessarily.
Can you tell me, well, that, okay.
I presented to you one possibility from that situation. If indeed that operator went bankrupt, that well and property could be sold to another who then provides the bond to the state in a cancelable situation. That is one possibility. If that doesn't happen, there's a ton of other possibilities, and I can't predict what would happen.
When a bond is canceled, there's no bond. Is that correct?
From that surety, correct.
Are you suggesting that if bonds can be canceled, which is a recommendation of yours, that they be non-cancelable unless there's another surety to take over that bond?
No, I'm not.
You have described these non-cancelable bonds as very hazardous. Who are they very hazardous to?
The surety.
They are the opposite of hazardous to the state of New Mexico, though, correct?
Correct.
Excuse me, I think I'm about done. I'm just double checking my list. You would agree the purpose of these rules is to protect the citizens of New Mexico from orphaned well costs, correct?
It is to protect the citizens, period.
And not the sureties.
No, the sureties are there to protect the citizens.
Oh, I had another question from your direct testimony. Actually, this is from your rebuttal testimony. What did you mean when you suggested that OCD might undertake a subjective and or disparate enforcement of these rules?
With district offices, it's possible that some of the rules can be misinterpreted by certain people, and that is a possibility with multiple offices.
Are you aware that OCD has eliminated district offices?
No, I was not.
Does that completely change your analysis on that matter?
No, there are also individuals within OCD in one office that can cause the same problem.
How would these new rules change the current framework of OCD with regards to enforcement?
Enforcement? That's a broad term. I couldn't explain that. I didn't look at that.
What did you mean by the word enforcement in your testimony?
Enforcement of the rules. Enforcement as a general term, I didn't look at.
I'll move on with this caveat. Are you saying that these rules will make OCD subjective and or disparate with the enforcement, whereas it's not now, or you think OCD is now?
With the definitions of marginal well and the bonding requirements associated with them, it is possible that marginal wells can be misclassified and bonds requested that may not be necessary, or too many bonds are requested from one operator, and that will affect how disparate or those rules can be applied.
Okay, I think I'm pretty close, Mr. Emmerich, but I wanted to quote you again from line 415 of your rebuttal testimony. And you stated, if it's not broke, don't fix it. What did you mean by that?
If present bonding rules are applied consistently and effectively, they can be effective in doing what is needed.
I believe you testified about the LFC report. Is that right?
I'm not sure what you're referring to.
The legislative finance report from the state of New
I'm
Mexico.
aware of it, yes.
Okay. I'm going to share part of that. Can you see that headline there?
Yes.
And what does that say?
Current orphan wells will cost the state more than 200 million. Future liability very likely exceeds 700 million.
You still maintain it's not broke and it needs no fix?
What I'm saying is that the basic framework can be effective if assigned. But I see a lot of small bonds that have been issued to the state in the past. And the current blanket bond and single well bonds that have been issued under the present rules are very effective. But there are no 3,000 or 2,000 or 7,000 amounts anymore. What has gone on past, which is, I think, what has been causing the problem.
I'll pass the witness. Thank you, Mr. Emmerich.
Thank you.
Thank you, Mr. Hall. Mr. Moore, do you have questions of Mr. Emmerich?
Excuse me. Can I have a break?
Yes, yes, certainly. Let's come back at 3:05.
Thank you.
All righty. It is, let's see, Mr. Moore's turn to ask questions of Mr. Emmerich. Mr. Moore, do you have questions?
I do, Madam Hearing Examiner. Thank you. Good afternoon, Mr. Emmerich. My name is Richard Moore. I represent the Commissioner of Public Lands and the State Land Office in this proceeding. How are you this afternoon?
I'm doing well, thank you.
Thank you. You testified in your SIR rebuttal that the State Land Office that no surety would pay the State Land Office on a bond to which the OCD is the obligee. Is that correct?
Correct.
So the State Land Office would not be able to collect on such a bond for damage to state minerals managed by the State Land Office.
If the bond was written to New Mexico for the use and benefit of the OCD, no.
And if the bond was written that way, would the State Land Office be able to collect on the funds secured by that bond to conduct reclamation on state trust land?
That I wouldn't know.
But your testimony is that no surety would pay the State Land Office for on a bond to which OCD is the obligee.
Objection asked and
Correct.
answered.
And
Okay. Go ahead, Mr. Moore.
But is your answer different based on your prior answer that if the State Land Office was seeking those funds to conduct reclamation on state trust land?
No, the bond is the commanding document, and what the sureties have to follow. They could not pay SLO directly, no, unless the OCD who made the claim would have an agreement to pay you. That is the only way that is possible.
Okay, but the State Land Office would not be able to directly draw on a bond to which the OCD is an obligee to conduct remediation of contamination on state trust land.
Well, you're confusing the issue. Let me put it this way. SLO could not make claim on the bond.
Yes, sorry if my question wasn't clear. So you agree that the State Land Office could not make a claim on a bond to which the OCD is the obligee in order to pay for remediation of contamination on state trust land.
For whatever purpose, yes, that's correct.
If a surety issued bonds to which the State Land Office was the obligee, would the State Land Office be able to claim those bonds to pay for damage to state minerals, remediation of contamination, or reclamation on state trust land?
If the SLO was the obligee, yes.
And so would you agree that in order to be in the position to be able to claim to draw on financial assurance in order to protect state trust land, the State Land Office would need to require bonds to which for which the State Land Office is the obligee?
Well, if SLO wanted to make claim and receive the funds directly, yes. But isn't there also a possibility to come to agreement with the OCD to give you the funds once they receive it?
That's a separate issue, and I think as others have said, we're simply asking you these questions.
My apologies.
No worries. But I just wanted yeah, I believe that you've answered my questions, and so I will pass the witness. Thank you.
Thank
Thank
you.
you.
I don't know if Ms. Nanasi is with us. Mr. Maxwell?
No questions. Thank you.
Thank you. Mr. Rankin, do you have questions of Mr. Emmerich?
I do not. Thank you, Madam Hearing Officer.
Mr. Sayer? No questions. Mr. Cloutier?
Just a couple of questions, Madam Hearing Officer. Good afternoon, Mr. Emmerich. Thank you for your time and testimony. My name is Drew Cloutier, and I represent the Independent Petroleum Association of New Mexico. Were you present when applicants were presenting their case when I believe it was Mr. Morgan testified that ability to obtain a surety bond was that ability for an operator was a proxy for the risk that the state of New Mexico takes that the operator will plug and abandon a well?
I don't remember that specifically, but if he said that, fine.
Okay. Would that be an accurate statement if he said it?
Well, I wouldn't say it exactly that way. I see things a lot simpler. The operator requires a bond, the surety provides it and provides it to the state. That's as simple as I can put it.
And what about a operator's inability to obtain a surety for, say, 2.5%? Would that be a proxy for risk?
Well, the surety market is one. If the surety market as a whole made that same decision, then he could explore either a letter of credit or a cash bond.
Thank you, Mr. Emmerich. Mr. Hall was asking you some questions about the cancelability of bonds and the OCD bond form. Do you recall those questions?
Yes.
Were you present for testimony that the OCD will release marginal well bonds if the operator is able to restore production in such a way that a well will no longer be deemed marginal under the rules proposed?
Yes.
Would the surety price the bond that it was in a form that it was releasable, in your experience, under the current bond form?
Please ask that question again. I'm not sure I understand it.
Sure. We're talking about the bond form that you've testified to for the OCD, correct?
Correct.
And did I understand your testimony correctly that the language in the bond form is read by the surety industry as it being a non-cancelable bond? With me so far?
Yes.
If there was a possibility that the OCD would release the bond because the well became non-marginal, would the surety industry price the bond as a cancelable bond?
No.
And why is that?
Because it's a non-cancelable bond.
All right. No further questions, Madam Hearing Officer.
Thank you. Mr. Swazo, do you have redirect?
Yes, I do, Madam Hearing Officer. Mr. Emmerich, I'm going to ask you a few questions based on the questions that you were asked on cross. Let's talk about the cancelable nature of financial assurance. Is financial assurance a contract?
It's a contract of a type, I suppose. Yes.
Does that mean that the terms of the contract control?
Yes.
I'm going to show you a letter of credit. Jacob, if you can pull that on the screen, it's going to be curious. Can you see that, Mr. Emmerich?
Yes.
Does the New Mexico OCD letter of credit form have an expiration? Sorry, it's on page 2.
Based on the initial 5-year term will automatically, it's an automatically renewable form. Unless notice of non-renewal is provided to the OCD, yes, it is cancelable.
All right. Do you recall being asked? Sorry, just a second. Do you recall being asked about whether you reviewed the New Mexico Administrative Code or NMAC, as you call it?
Yes.
I'm going to pull up a section of NMAC for you to look at. It's in the email. It's 811. All right, Mr. Emmerich, can you see Rule 1915-811?
Yes. And this is what I think I saw before.
So you have reviewed this section of the New Mexico Administrative Code before?
Yes.
Okay. And do you see subsection C?
Yes, I do.
Can you tell us what that says?
That says letters of credit shall provide for automatic renewal for successive like terms upon expiration, unless the issuer has notified the division in writing of non-renewal at least 30 days prior to expiration.
Does that mean it's cancelable?
Yes, in other words, the surety has to provide New Mexico notice.
So
In
that
that
means
way,
sorry.
cancelable.
So that means it's like the form, correct?
Oh, yes,
Before-
absolutely.
Okay. So then is it accurate? Oh, and does it have a 5-year maximum that you can tell?
Yes.
So is it your
That's in
understanding? Is it your understanding that they can call the letter of credit irrevocable, but that's not what the form and the regulations say, correct?
Well, that's the way I'd view it. I don't know why they call it irrevocable if it is non-renewable or cancelable. That's not what I understand irrevocable to mean. If you look at 1915-812, the division shall release a financial assurance document upon the operator's or surety's written request if all wells drilled or acquired under that financial assurance has been plugged and abandoned and the location restored and remediated. Now that is exactly or more or less what the bond does. But the earlier provision makes it non-renewable or cancelable.
Objection on optional completeness. I would ask the witness to read the rest of that section A there.
Mr. Swanzo, would you ask him to do that?
Yes, Mr. Emmett, can you please read the rest of that rule?
Let me start over. The division shall release a financial assurance document on the operator's or surety's written request if all wells drilled or acquired under the financial assurance have been plugged and abandoned and the location restored and remediated and released pursuant to 1915-25-9 NMAC through 1915-25-11 NMAC, or have been covered by another financial assurance the division has approved.
And if you scroll further down where it says forfeiture of financial assurance under 1915-813, can you read subsection D, please?
B says if the financial assurance proceeds exceed the
No,
costs.
D is in Delta.
D, I'm sorry. The division shall deposit forfeitures and funds collected pursuant to a judgment in a suit for indemnification in the oil and gas reclamation fund.
Thank you, Mr. Emmerich. No further redirect questions, Madam Hearing Officer.
Thank you, Mr. Swanzo. Commissioner Mpoma, do you have questions of Mr. Emmerich?
Yeah, would Commissioner Bloom go first?
Would Commissioner
Sure,
Bloom?
absolutely.
Yeah, great.
Okay. Good afternoon, Mr. Emmerich.
Good afternoon.
Excuse me, a little bit under the weather here. Mr. Emmerich, Mr. Swazo asked about my previous question regarding your testimony regarding W&T. And I believe my question was along the lines of, aren't the proposed $150,000 onshore bonds that we're discussing here today and W&T's, I think it was $55 million offshore bond, aren't these essentially apples and oranges?
No.
Why not?
The each bond has an amount associated with it. The form is the two forms, both New Mexico and the federal form, are non-cancelable bonds, and in that way they're exactly the same.
What about in terms of the risk that can come from offshore and the greater amounts of money that are at stake?
Those are very different.
That's what I was thinking, and I was working for the head of the U.S. Senate Energy Committee back in 2010 at the time of the Deepwater Horizon disaster, and it took a year of my life and dominated a summer of work. And I know that the lawsuits there and fines were into the billions of dollars, so that's why I considered that a sort of apples and oranges. But I understand your answer. Thank you. Again, as a commissioner here and a regulator, I'm struggling with NMOGA's recommendations. You say, for example, quote, adopt BOEM style safety valve and cite the CFR. What we need is testimony as to why we should accept or adopt BOEM style safety valves. We need to justify, OCC actions. Do you understand that?
Yes, I do. I provided that as a consideration for OCC and OCD to consider, to more or less another tool in your financial assurance chest to make sure that the citizens are protected and that whatever is available from the operator can be used for that protection.
Okay, thank you. And I think my last question is, and, you know, the same thing goes for recommendations like clarify definitions for consistency and predictability. Of course, that's something, you know, we would strive to do, along with, well, I would use that example. And in those cases, you know, things like a red line draft are helpful. And I just hope that, you know, your party understands that in terms of the things we need to do to craft this rule, particularly once we get to deliberation. Does that make sense?
I got that message loud and clear.
Okay. Those are all the questions I have, Mr. Emmerich. Thank you for your time today. I appreciate it.
Thank you, Commissioner Bloom. Commissioner Impoma.
Thank you, sir, for your testimony today. So the same as Commissioner Bloom said, I just want to make sure that you did not really present any red lines recommendations for the consideration of the commission other than the overall big recommendations. Is that a true description of your testimony?
As far as it goes, yes.
I do not have any further questions for you. Thank you.
Chair Chang, do you have questions of Mr. Emmerich?
I think this has already been covered